Welcome to the Tech Index AI podcast, where we blend tech IP data, reports, and charts with the latest news and all things logistics with a focus on air cargo. Today, we're doing a deep dive into the latest Tech Index data from October 7th. We really want to unpack some of this localized rate volatility and connect that to what's happening with logistical capacity, especially here in North America, and maybe touch on those macro pressures from energy, too.
Right, and it's interesting because if you just glance at the global average, the BAI 0, you'd see rates were up slightly again, maybe 1.9% this past week. Looks stable, but honestly, that stability, it's really deceptive.
Okay, how so?
What's really driving that average up is a huge short-term rush. Deliveries out of China that got delayed.
The Typhoon. Super Typhoon Regasa, right?
Exactly. So there was a backlog, and now everyone's trying to catch up. That pushes the average.
Makes sense. And the Asia data seems to back that up.
It does. Hong Kong, the BAI 30, that was up 1.5%. Shanghai, BAI 80, up 1.3%. Classic post-disruption bounce.
But what's interesting there is it sounds like capacity might be coming back elsewhere already. You mentioned Vietnam.
Yeah, that's a key contrast. Rates out of Vietnam, heading to Europe and the U.S., were actually lower week on week.
Lower. Why?
It suggests increased capacity on those specific routes is already kicking in, sort of dampening prices there, even as China recovers.
So definitely not a single global trend then. It's very regional.
Intensely regional, yeah. It's almost like different markets in conflict. The contrast between Europe and North America really tells the whole story.
Okay, lay it out for us.
Well, look at Europe. London Heathrow, BAI 40, just had this massive spike. I mean, really huge, up 15.6% since last week.
15%, wow.
Yeah, and that puts Heathrow almost 24% ahead compared to last year. It's being driven by really strong rates going to Southeast Asia and, importantly, to North America.
Okay, so strong demand into North America from Europe. But what about the other way?
Well, you cross the Atlantic, and it's a completely different picture. Chicago, the BAI 50, just keeps sliding.
Still weak?
Still weak. It shed another 1.8% this week, and that leaves it down, get this, nearly 30% year over year.
30% down, that's huge.
It's its lowest index level in over 2 years. It points to a fundamentally weak U.S. export market, at least out of that hub.
And frankly, a 30% drop sounds pretty bad on its own, but you mentioned connecting this to capacity issues.
Yes, exactly. That weakness in Chicago is bad, but what's happening now operationally in the U.S. is layering on a whole new problem. We have to talk about the physical constraints.
Because of the government shutdown.
Precisely. The U.S. aviation system is under, well, severe stress.
So the FAA, they're having staffing problems.
Big time. They've had to delay flights for, I think it's 3 straight days now. Air traffic controllers, TSA officers, they're working without pay.
Right. And that directly hits capacity, doesn't it?
Absolutely. This is where the capacity failure really, really bites. The numbers are quite dramatic.
Like what?
Over just Monday and Tuesday, more than 9,000 flights in and out of U.S. airports delayed.
9,000?
Yep. And the Secretary of Transportation highlighted this normally. Maybe 5% of delays are blamed on tower staffing. Lately, it's jumped to 53%.
53%. That's unbelievable.
And you have to remember, the FAA was already short-staffed before this shutdown. They needed about 3,500 more controllers just to hit targets.
So the system was already stretched thin, and now this.
Exactly. Major hubs like Reagan National, Newark, Chicago O'Hare, they're all seeing delays. It puts immense weight on an already fragile system.
Okay, so we have this massive operational problem brewing in the U.S., potentially choking capacity. What about other pressures? Fuel.
Yep, that's the other macro headwind. Jet fuel cost.
Yeah.
Well, we use oil futures as a proxy, right? WTI, Brent. They both rose again, continuing their recovery.
Even with U.S. crude stocks building more than expected.
Yeah, the market seems to be looking past inventory right now and focusing more on risk.
Geopolitical risk?
Specifically, those Ukrainian strikes on Russian refineries. That's adding a risk premium to the price. The takeaway is pretty clear. Logistics runs on energy, and energy just got politically more expensive. Supply chain costs are going up.
So fuel costs rising, U.S. operational capacity creaking.
Yeah.
But then you look at the broader stock market.
Right. It's a strange dual reality. You've got the S&P 500, the Nasdaq hitting all-time highs, lots of excitement around AI tech driving that.
So optimism there.
Huge optimism. But at the same time, that very geopolitical uncertainty that's pushing up fuel costs, it's also pushed gold, the classic safe haven asset, above $4,000 an ounce.
4,000. Wow. So tech optimism on one hand, serious nervousness on the other.
It's a very, let's call it an expensive optimism in the global economy right now. Nerves are definitely showing.
Okay, so let's try and synthesize this deep dive for you, the listener.
Right.
We're seeing air freight rates bounce back a bit, mainly driven by that short-term typhoon recovery in Asia.
But those recovering rates are running straight into rising fuel costs, driven by geopolitical risk.
And critically, right underneath all that, the actual operational capacity in the U.S. air system is under severe acute strain because of this FAA staffing crisis during the shutdown.
Which leads us to the really crucial question, especially as we head into Q4, the big holiday season push.
Right.
You have to ask, if the U.S. is already dealing with these major staffing-caused flight delays now, just as air cargo usually ramps up, what does that capacity failure mean for the lanes into North America?
The inbound traffic.
Exactly. If this staffing crisis continues and capacity stays choked, those inbound rates could spike dramatically. It could create a perfect storm, a real capacity crunch that undermines global holiday logistics just when everyone needs them most. Something definitely to watch.